So what do you get when you take a 70-year-old Nobel Prize-winning idea and give it a massive upgrade with modern AI? Well, we're about to find out. We're going to break down a brand new method that's all about building smarter, tougher investment portfolios. You know, it's pretty much the oldest rule in the book, right? No risk, no reward. Every single investor, from the seasoned pros to someone just dipping their toes in, gets this fundamental trade-off. If you want a return, you've got to be willing to take on some risk. But that right there is the billion-dollar question, isn't it? It's one thing to say no risk, no reward, but it's another thing entirely to actually manage that risk. How do you tilt the odds in your favor to squeeze out the best possible reward for the risk you're okay with? And this really gets to the heart of it, the investor's timeless dilemma. We're talking about the market's built-in volatility. Trying to navigate all that uncertainty, well, it's not about getting lucky. It's all about having a solid, systematic game plan. Okay, let's start with the absolute basics. Imagine you put all your money into just one company's stock. That's a huge bet, right? If that company takes off like a rocket, you look like a genius. But if it stumbles or even fails, your investment could literally go to zero. And that's a kind of risk most of us just can't and really shouldn't take. So, how do you solve a problem like that? Well, the answer, the big idea that laid the groundwork for everything, was so revolutionary it actually won a Nobel Prize. Yeah, way back in 1952, an economist named Harry Markowitz developed a mathematical framework that just completely changed the game. It's called modern portfolio theory, and believe it or not, it is still the absolute bedrock of how professional investing is done today. And the core idea? It's brilliantly simple. I guarantee you've heard it a million times. Don't put all your eggs in one basket. What Markowitz did was prove mathematically that by mixing different assets together, you could actually lower your total risk without having to give up your potential returns. The whole thing just boils down to finding that perfect balance between expected return and risk. Okay, so here's where it gets really cool. There's this concept called the efficient frontier. And honestly, the best way to think about it is like a menu of the best possible portfolios. For whatever level of risk you're willing to take on, the efficient frontier points you to the one single portfolio that gives you the absolute highest possible return. It's the perfect sweet spot. All right, so that's the classic playbook. That's the foundation. But this is where things get really interesting, because researchers have now built a new model that takes this classic 70-year-old theory and gives it a massive AI-powered upgrade. Now, the key thing to get here is that this isn't about throwing out Markowitz's theory. Not at all. It's about making it way more powerful. See, this new fusion model works in two main steps. First, it uses AI to actually predict where stock prices are going. Then, and only then, it takes those smart predictions and feeds them into the classic optimization model. It's like giving an old, reliable engine some brand new, high-octane fuel. So how does it actually pick the winners? Well, it definitely doesn't guess. It runs this really rigorous screening process. It's looking for a very specific cocktail of qualities. We're talking high growth, low volatility, and a real track record of beating the market. Basically, the whole point is to create a short list of only the absolute strongest companies to even consider. Okay, so once it has that short list of heavy hitters, the model starts building the portfolio, kind of like a master architect. It has these super strict rules to make sure everything is diversified. No single stock is allowed to take over. It uses this clever technique to pick the best combination without making risky bets, like short selling. And only after all that does it run the classic math to figure out the perfect risk-balanced mix. Okay, the theory sounds impressive, right? It's a really smart two-step process, but the big question is always, does it actually work in the real world? Let's take a look at the results. All right, here it is. This is the exact portfolio the model put together using stocks from India's Nifty 50 index. You can see the companies right here and their exact weights. And notice how it's not all just one sector, right? It's a really deliberate mix of different industries. You've got tech with TCS, consumer goods like Asian Paints and Titan. It's a real blend. So what was the bottom line for this carefully built AI supercharged portfolio? How about an annual return of 46.5%? That is a seriously impressive performance. And it wasn't achieved by luck or wild guessing, but by a really systematic, data-driven process. But a high return is really only half the story. To see the real power of this model, you've got to see how it stacks up against an older approach. Sure, the return was a little bit higher, but look deeper. It got that return with way better diversification, spread across 13 stocks, while the other model was jammed into just a few. And here's the kicker. None of its chosen stocks lost money. Not one. Now look at the error rate. That's the gap between what it predicted and what really happened. It was less than half. So this isn't just about chasing bigger numbers. It's about getting more reliable, better managed returns. So what does this all mean for the big picture? I mean, are we looking at the future of investing here? It really feels like we're watching a pretty significant step forward in how we think about building a portfolio. So let's just recap the key takeaways here. First, those classic theories, like modern portfolio theory, they're not going anywhere. They're still the absolute foundation. Second, AI and machine learning can act like a supercharger for these theories, giving them predictive power they never had before. And when you fuse these two things together, you get better diversification and much smarter risk management. The bottom line is this. We're looking at a data-driven approach that can deliver strong, consistent returns. And that leaves us with a really fascinating question to think about. I mean, this model got these incredible results just by analyzing old financial data. So what happens next? What happens when these models start analyzing real-time market news, social media sentiment, everything? We might just be at the very, very beginning of a whole new way of investing.